Could the per ounce price of gold double or even triple from here? Is it a pipe dream or a legitimate possibility? I sit with legendary metals commentator Rick Rule today to discuss.
Welcome to Inside the Vault with SWP. Join Mark Yaxley as we explore the latest news, reports, and some bullion basics for investors old and new. Let's get to it.
Hello, everyone, and welcome back to Inside the Vault with SWP, a weekly show where we dive into the worlds of precious metals with the brightest minds in the space. If you're new to the show, you can view all of our previous episodes on the SWP YouTube channel alongside a ton of other great educational content. While you're there, please do like, subscribe, and hit that notification bell so you don't miss when our new episodes go live. I'm your host, Jeremy Varlow. Another exciting day for us today. As I mentioned, I'm joined by Rick Rule for a discussion. You won't want to miss this conversation. Rick will be with us in just a moment. But as we always do, let's start things with our weekly market update with CEO of SWP, Mark Yaxley. Mark, how are you doing today?
Hey, Jeremy. Such an honor to have Rick join us today. The man's a legend, and I'm looking forward to hearing his thoughts on the market. To get things kicked off, listen, Iran and Israel are driving the headlines at the moment as the two nations exchange verbal warnings about further retaliations following last week's bilateral attacks. This has clearly resulted in a regional escalation, despite the somewhat telegraphed and controlled nature of the attacks and the retaliatory threats. The fact remains, Jeremy, that the world is a more dangerous place today than it was just 2 weeks ago. Over the past 5 trading sessions, we've observed significant volatility in the prices of precious metals, particularly the silver price, as it attempts to break out of the $28 range and hold above $29 US an ounce. Gold has tested and failed to break $2,400 an ounce again. Earlier today, we've seen some strong corrections lately for the precious metals, and I expect that we're going to continue to see relatively dramatic intraday movements for the time being. These corrections are healthy and, of course, can present good buying opportunities. On the demand side of the equation, we're seeing continued strong buying from China, with premiums surging in both gold and silver there. Globally, gold ETFs witnessed their 10th consecutive monthly outflows, believe it or not, yes, outflows, in March, losing a net of 823 million US dollars. Flows in North America, however, did flip back to positive for the first time in 2024. That was in March. But those were offset by net outflows in Europe as per the World Gold Council. Jeremy, the current theme is volatility. The world is at a point in time where many significant things are playing out all at the same time. We're experiencing geopolitical shifts. We're seeing monetary regime shifts. We're seeing cultural and social regime shifts powered by social media and information wars, capped off with accepting that inflation just won't go away and higher for longer interest rates. What I see is that gold's recent performance is a measure of how unstable things are, and that people at all levels of society are expressing their concerns by buying the yellow metal. Really looking forward to see what Rick has to say about it. Back to you, Jeremy.
Yeah, that's a great way to tee up our guest for today. I think we're going to talk about a lot of those things you just spoke of, Mark. Let's bring in our guest. As I mentioned, we are very excited to welcome someone that all metals investors will be familiar with. Mr. Rick Rule joins us today. Rick is a renowned investor, financial commentator who specializes in mining, metals, and energy. He is also the founder of Rule Investment Media and the host of the Rule Symposium, which is the leading annual event on resource and commodities investing happening this July in Boca Raton, Florida. Rick, welcome to the show.
Jeremy, thank you. And thank you for that kind introduction. I appreciate it.
Yeah, it's really great to have you on. Let's jump into things here. Let's zoom out and talk kind of bigger picture, what Mark was just talking about. Obviously, we've got the geopolitical side of things. Let's talk about kind of the more macro side of things that are going on within the United States right now. Obviously, interest rates and inflation are at the top of everyone's mind at the moment. Late 2023, early 2024, everyone had kind of priced in rate cuts starting in Q1 of 2024. We've seen that pushed back repeatedly since then. I'd like to get your thoughts on kind of the push and pull of interest rates and inflation. And also, if you could touch on, I noticed you mentioned this in a previous interview that I saw on YouTube, what you say is the true measure of inflation and why CPI is flawed, just kind of getting your big picture view on all of these things.
That's a big bunch of questions. Let me try. First of all, I need to say I'm surprised and delighted by the relative strength of the U.S. economy. Yes, there are winners and losers in the economy, and there are a lot of people who are struggling. But if you look at the fact that we have at least doubled nominal interest rates in 3 years, and we haven't had a major downturn, as an example, in aftermarket housing or in consumer durables, or even a major downturn in the market for sub-investment grade private credit, the economy has done a truly spectacular job. I think, I'm not an economist, so I say I think that that's due to very high liquidity, due to very, very, very high private savings in the U.S. market, $6 trillion in cash and cash equivalents, as an example. But it's also due, I think, to the underlying strength in the American culture, which is to say that this is still a place, despite the idiots in Washington, where 5 or 6 young kids can commandeer a garage in Sunnyvale, and out pops Google or Facebook or Apple, separate and apart from the market performance of the so-called Magnificent Seven. The improvements in productivity and the improvements in life that have happened as a consequence of American technology have been truly amazing. And I'm heartened, although I'm surprised, by the strength of the U.S. economy. Are there problems? Absolutely. And the problems are terrifying. The extraterritorial or the attempted extraterritorial reach of American power, the fact that we're trying to fight 15 beefs simultaneously, is idiotic. The attempts by the American government to undermine the U.S. dollar by the imposition of extraterritorial force through the SWIFT banking system is an insanity. But the biggest insanity is the level of government spending and the level of debt. The on-balance sheet liabilities of the U.S. government now exceed $34 trillion. And people's eyes glaze over when I use that number because they don't know what a trillion is. Suffice to say, it's big. But the off-balance sheet liabilities, Jeremy, are what scare me. Your audience can identify those liabilities by looking at the screen. I'm a 71-year-old guy, Medicare, Medicaid, Social Security. In other words, me. I'm the problem. We have well in excess of $100 trillion in net present value of liabilities in the United States in promised entitlement payments. That means if you add the off-balance sheet liabilities and the on-balance sheet liabilities at the federal level, not including state and local, your number exceeds $140 trillion. And that number is growing by $1 trillion every 100 days. I know how we get out of this. We did it in the decade of the 70s. We do it by reducing the net present value of the denominator. In the decade of the 70s, we reduced the purchasing power of US dollar savings by 80% in 10 years. That's how we do it. We, of course, hopefully vote to end the benefits enjoyed by my generation, or some of them. My generation voted ourselves all kinds of cool benefits and we forgot to pay for them. We left it to you. I don't know how you feel about that, but I have my suspicions. So I'm concerned about these things. And the third part of your question is probably the most important thing I'm going to say to your audience today. The measure of inflation, if you define inflation as the deterioration of purchasing power of fiat currency units, in this case, the US dollar, is improperly measured. The CPI has been popularly referred to as the CP lie. And I think that's a useful slogan. First of all, the CPI, when it's inconvenient, measures core inflation, which is to say non-food and fuel. Well, that's okay if you don't eat. Your audience can tell by looking at me, I'm rather portly, I like to eat. And so a measure that doesn't include food is of very little use to me in terms of understanding the deterioration of my purchasing power. Importantly, too, the measure is, quote, hedonistically adjusted, which means that they assign arbitrary values to something like the quality of the housing you live in or the function of your computer rather than paying attention to its price. But the oddest thing about the CPI as a cost of living index is that it doesn't include tax. For most Americans, tax is the largest component of their household cost of living, greater than shelter, greater than food, greater than energy, greater than transportation combined. If you measure the rate of inflation in the United States in the same fashion that you measured inflation in the United States in 1980, the last time that we appeared to be concerned, US inflation is progressing at about 8 or 9%. If you add back the cost of government, I don't know what the arithmetic is, but it scares me. I did a thought experiment myself. I don't have to buy much. You know, I'm an old, fat, rich guy. I don't need many material things. Those that I need I already have. And I find that including tax, the purchasing power of my savings is declining between 7 and 8% compounded per year. Now, that number is scary enough at the onset. But if you look at the rate which is available to me on my savings, measured by the US 10-year Treasury, the deepest and most liquid savings asset on the planet, they're going to pay me 4.5% in a currency where my purchasing power is declining by at least 7, which means they absolutely positively guarantee me to cost me 2.5% of my wealth every year for 10 years. The first government promise that I'm absolutely certain that they will keep, and not a good one.
Yeah, it's interesting that I was hoping that you were going to mention CPI and how it's a flawed measure there, because I look at it as well. I mean, what do I spend the most money on per month is food and gasoline. It's like,
no, you don't. You pay the most in tax. That's what you spend money on.
I live in the Cayman Islands, so that's the one caveat is I don't.
Good. Well, indirectly you do, because when you buy a car, 25% of the value of that car throughout the production chain is tax. Sure. So although they don't get to steal it from you indirectly, believe me, they pick your pocket every which way until that good gets to you. But congratulations on having the good sense to avoid them being able to steal from you directly.
Well, I mean, just take one look at the grocery stores in here and you'll realize that they're making it up in other ways for sure. So then the question kind of comes down to, what does the Fed do in this situation? You mentioned the debt level, you mentioned the interest payments on that debt versus letting inflation run rampant. They're stuck between a rock and a hard place. Where do they go from here?
They are. I need to say, I think they've done a remarkable job. An absolutely remarkable job. You can tell by my shirt. I have a banking organization, Battle Bank, so I have occasion to deal with the Fed, at least at lower levels, a lot. And I hate to compliment a government arm, but I need to say, at least at the lower level, that they are a remarkably good crew of people. I really hate saying that, but I have to. And I would say that informally, the consensus among lower level employees at the Fed is that they need to keep interest rates higher. Mm-hmm. The employees of the institution believe that they are really the only thing that stands between us and the rapid deterioration of the US dollar. They see no fiscal restraint from either Democrats or Republicans, either at the executive or at the legislative branch, nor in most states. And so the consensus of the lower level Fed employees, I think anecdotally, is to keep interest rates nominally high. Understand that in real terms, interest rates are stupidly low, but in nominal terms, they're high. I think that the political pressure in an election year on the Fed, right, and I think the fact that the senior Fed employees are basically political appointees, will make it very difficult for the Fed to maintain these nominally high interest rates. I hope I'm wrong. But I'm concerned about that. I don't see any pressure from either Democrats or Republicans to restore market forces in interest rates. I see them as a political tool. And so my suspicion is, if not in 2024, then in 2025, that you're going to see lower nominal and much lower real interest rates, which I think is unfortunate.
You mentioned something there, and this is maybe education for myself, but you mentioned that nominally interest rates are stupidly low. And I mean, compared to 2020 to 2023, I mean, they were much, much lower. What do you mean by that? How do you, quantify that?
The sad difference between your time on Earth and mine, historically, there has been a real return on capital employed above the rate of inflation. If you assume that the deterioration in purchasing power in US dollar denominated instruments is between 7 and 8% per year, from a historical viewpoint in free markets, the margin above the rate of deterioration of the currency and the real rate of return has been between 30 and 40%. So one would expect, if you accept the 7% number as the true number with regards to the deterioration of your purchasing power, a real riskless interest rate, which is to say the rate on the US 10-year Treasury, should be 10. It should be 300 basis points at least, maybe, okay, call it 250 basis points, 9.5. It should be enough to give savers a real rate of return, a real riskless rate of return above the rate of the deterioration of the purchasing power of their assets. I think it would be interesting to look at the US housing market or the US corporate debt market or the US long bond market if we ever reverted to mean in terms of real interest rates. We did it in the late 1970s, and we broke the back of inflationary expectations. But for those of your audience who weren't present, it was an interesting experiment and not altogether pleasant.
Yeah, certainly. Thank you for that. That's a bit of like an economics and history lesson for me, so I appreciate that. Let's go to metals now. Obviously, Mark talked about the price action in metals over the past week, but zooming out even more to the performance of gold and silver in 2024 in general, metals have performed very, very well. Mark did mention we've seen increased volatility in metals of late. I'm wondering what you make of the recent price run up over the past couple of weeks to a month, as well as that increased volatility.
Let's deal with overall volatility first. I'm amazed that volatility is as small as it is. If you look at both the liquidity, which should take the price of assets higher, and political uncertainty and debt, the collision of those two forces, positive and negative, should be, I would suspect, like the collision of two major weather systems. In other words, we should be experiencing a real storm. We should be experiencing, from my point of view, a VIX that is 25 or 30 as opposed to 15. Shows what I know, which is to say not very much. Now, let's do gold. When people ask me when the gold price is going to move, I need to look them in the face and say 2000. In the year 2000, gold was priced at $250 an ounce, and it's now what, 24?
Yeah,
gold has generated 8.6, 8.7 compound cumulative annual internal rate of return, which is to say, if an inflation rate is 7, gold has done its job. It's given you a real yield net of inflation, which is precisely what it's supposed to do. People's expectation of gold, I think, was set in the decade of the 70s, when it went from $35 to $850, which is an incorrect perception. It was a coiled spring at that point in time. I need to say, too, that I'm not involved in the gold market because of a move from 2,150 to 24 or something like that. I'm in the gold market because I remember the decade 2000 to 2010, when the gold price went from $200 to $1,900. I'm not saying that you're going to get a threefold move in gold, but I'm certainly not saying that you're not. The set of circumstances that is in front of us is remarkably similar to the set of circumstances that confronted us in 1968, in 1973, in 1976, and in 1998. wouldn't, and don't take this as a prediction, don't use it as a clickbait headline, but a move in gold from 2,400 or whatever it's at to some number with a 7 or an 8 or a 9 wouldn't surprise me at all. I hope it doesn't happen, because the world that you and I would live in with a $9,000 nominal gold price would be much less pleasant than the world that we live in today. That notwithstanding, I own gold for insurance purposes. I own gold because I think that there's a possibility that there's a quantum move in gold, which would disrupt other things. Looking at the structure of today's gold market is fascinating. The gold price is moving up without retail participation. Retail participation is all on the sell side. If you look at the ETFs, not just in North America, but in Western Europe too, what you see is retail disintermediation, retail selling. And if you look at a more granular level on the street, you are seeing people greet the increase in gold price by taking their jewelry in for scrap. In other words, turning a savings asset into a consumable asset, which is to say cash. The strength in the gold price seems to be occurring as a consequence, of Asian retail buying, but much more importantly, central bank buying. That's very easy to understand. The U.S. government is forcing the disintermediation of the U.S. dollar. The U.S. government began by weaponizing the SWIFT banking system. That is, inadvertently, perhaps destroying the attractiveness of the US dollar as the world's reserve currency by politicizing the medium of exchange. Profoundly stupid. Profoundly stupid. The idea that the challenge to the US dollar is in Beijing or Moscow is insane. The demise of the US dollar is being engineered inadvertently in Washington. A second circumstance was, of course, the confiscation of $300 billion of U.S. Treasury securities owned by the Russians. Whether you agree with U.S. policy or not, you need to understand that doing this certainly reduced the attractiveness of U.S. Treasuries in other regimes that think that they might have something to fear from the United States. Most importantly, of course, our largest creditor, the Chinese. The third question is that central bankers can do arithmetic. The idea that you subject yourself to arbitrary American policy to get a 4.4% yield in a currency where your purchasing power is declining by 7% means that you aren't getting paid to take the risk of US political idiocy. Combining all those with the fact that while those countries don't trust us at all, they still trust us more than they trust each other, which is to say the Chinese don't want to end up with trillions of rubles. The Indians don't want to end up with trillions in renminbi. They want to settle in a convertible currency in a liquid and transparent market, means that they have been forced to buy gold, to use as a store of wealth and to use as a medium of exchange. If you overlie the fundamentals of the need for central banks to increasingly use gold as a medium of exchange with what I think is the probability that Western savers will re-engage with gold, given the lack of arithmetic attractiveness of U.S. Treasury securities relative to the deterioration of the purchasing power of the U.S. dollar, you have the stepping stones in place for a dramatic market, a really, truly dramatic market. Is it a probability? I don't know. Is it a possibility? You betcha. One more statistic, and I'm sorry for this long-winded answer, but this is a big question.
Take it away.
Market share. In the U.S. market, the market share of precious metals and precious metals-related investments is less than 0.5% of the total savings and investment market in the U.S. The 4-decade mean is 2%. Gold doesn't have to win the war against the US dollar. It doesn't have to win the war against the US Treasury. It just has to lose it less badly. If you have reversion to mean, which is precisely what I think is going to happen, demand for precious metals and precious metals related investment products quadruples in a market that currently comprises 23% of the world's savings and investment assets. Remember that prices are set on the margin. They're not set across the whole market. They're set on the delta between supply and demand. And if you increase demand fourfold, which is precisely what I think is going to happen, that could have an outsized leverage impact on price, which is what I'm afraid might happen.
That's incredibly interesting, and I mean, it's hard to wrap my head around, a gold price that starts with that 7, 8, or 9 figure.
That isn't the price projection, Jeremy. It's important that you understand that.
Right.
But the conditions precedent are all arithmetic. They're non-narrative.
Right. Yeah, and I think that's the thing. You just look at the facts that are in front of you, and you go, well, this isn't out of the realm of possibility. So yeah, very interesting, but hard to wrap one's head around. I think this is actually a good time. I wanted to introduce kind of a new game, so to speak, where we kind of give you a couple of quick hitting questions and see what your answers are on the spot. And this is kind of geared towards education for perhaps new metals investors. But let's give it a whirl. Question number 1 for someone that's new to the metals space and is curious about investing in gold, silver, etc. Physical metals or dipping their toes in ETFs first?
Start with the physical metals. If you think the gold price is going to go up, buy gold. Don't buy a gold derivative. And if I had it, buy it in segregated storage. Do not bury it in the backyard. Midnight gardening exposes you to a whole different set of risks.
Well, that was actually my very next question, was following up on that, taking physical possession of at least some part of your portfolio at home or storage in a vault. I think you've answered that, but maybe you can elaborate on that a little bit more.
I used to believe that I had to pet my gold. And I came in my youth to come across 3 or 4 prior clients of mine who did the same thing and found themselves being visited by people who they normally wouldn't have over for lunch, exposing themselves to the risks that you can imagine. If you do store your own physical gold or silver, don't tell anyone. If you have a safe, don't. Have 2 safes. Have one safe that you have $1,000 in your passport, and have a different safe that you have your wealth in, so that if somebody comes and visits you, you can sacrifice your passport, your auto registration, 1 ounce of gold and $1,000 and pretend to be sad while the rest of your holdings are safely somewhere else. But honest to God, if you do this, don't talk about it.
Okay, good answer. Allocation split right now at these moment, at these prices, gold versus silver, any platinum, palladium, etc.
I own all of them, but I'm old and fat and rich. Mostly I own gold because I own it as an insurance policy. I own it as liquidity. I own it not because of greed. I own it because of fear. I own some silver because history has taught me that when the gold narrative goes to the generalist investor, that silver moves further and faster than gold. So I have a little bit of silver as a speculation. Not that I need to speculate, but because it amuses me. And I own platinum and palladium too. I own platinum and palladium because I think that they're depressed in price. They're depressed because the big thinkers of the world would have you believe that the internal combustion engine goes the way of the dodo. And platinum and palladium are used for auto catalysts. I believe the internal combustion engine will be with us till 2060 or 2070. So I think that demand for the catalytic anti-smog properties of platinum and palladium will persist much longer than the big thinkers do. And I think that the possibility of a supply shock around platinum and palladium is high. It is produced really in 2 countries, South Africa, a basket case, and Russia, a basket case. The down move in platinum and palladium prices and nickel prices for that matter, I think is due partly to the fact that, much like in 1990, the Russians need money for fairly obvious reasons, and they're selling whatever they have to sell, which includes prominently platinum and palladium. That selling pressure will end when the Russians run out of platinum and palladium, just like it did in 1992. In the interim, if you had any supply shock in either South Africa or Russia, which I think is a possibility, I think you'd see a dramatic re-rate in platinum and palladium prices. Will this occur? I don't know. So again, like silver, my holdings are speculative. If you can afford to speculate, it's a great speculation. If you can't afford to speculate, own gold.
Perfect answer. We don't talk about platinum or palladium enough on this channel, so I appreciate you kind of giving the primer there. Another one, and again, consider this is someone that might be relatively new to precious metals. Investing in metals, but also investing in miners. Are you looking at, investing in the sector, or is it best to just stick with the metals themselves?
That depends on how hard the investor wants to work and how much risk the investor wants to take. And I think that you need to segregate among the companies between investment grade stocks and speculative stocks. When you invest, too many people invest in the miners as though they're a leverage proxy for the metal, which is not true. They're a riskier proxy for the metal, but you need to understand something about the investment process. If you invest in the gold mining stock sector, you will lose money. That's a guarantee. If you invest in a subset of high-performing companies in that sector, good businesses in the sector, over the course of a decade, you will make money. My suspicion is that over the next 5 years, you'll make a lot of money, but that's a suspicion, not a suggestion. So if you're willing to do the work to educate yourself so that you can segregate in movie parlance between the good, the bad, and the ugly, by all means, own gold mining stocks and own them now. The lack of performance of the gold mining stocks relative to the gold price is historic, deserved, but historic. Mm-hmm. If you're willing to really work, if you're willing to try to generate alpha, you can come into the juniors. But you do that at your own peril. Now, I need to tell you that all the money that I now invest conservatively, I made by speculating wildly. So I'm not saying don't do it. I'm just saying be prepared to stomach as much volatility as I have, to take as much risk as I have, and to work as hard as I have if you hope to be a success in speculation. Be honest with yourself. And if you aren't willing to work at least 1 hour per month on every stock that you own, don't do it. Don't do it. Spend time with your grandchildren, read a book, have a glass of bourbon, do something productive.
I think that's a perfect segue into wrapping the show up. You mentioned educating yourself and having to do some hard work. I know that you've got both a boot camp and the Rules Symposium, which is your annual event coming up. Tell our audience a little bit more about those, where they can find more information and join up.
I have 3 things to tell you about.
Okay, great.
Rule Investment Media. If you like what I have to say about natural resource investing, and if that makes sense, go to my website, Rule Investment Media. List your natural resource stocks. Please no pot stocks. Please no crypto. Please no tech stocks. Just natural resource stocks. And I'll personally rank them for free, no obligation, 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments have any value. That's free. Why do I do that? Because after you do that, I want to sell you my educational products. My educational products include the boot camps. Every 90 days, we do an 8 or 8.5 hour online deep dive into some particular subject. We've done uranium. We've done silver. We've done royalty and streaming. We've done development stage companies. Coming up, we have the exploration stage prospect generators, the wildest, most speculative, and the most lucrative part of the value chain. Useful for those who are willing to do the work. If you really want to generate alpha in resources, you do it in exploration. But believe me, it's a rodeo. So you need to understand how to do rodeo. Go to rulesymposium.com. We're going to charge you $99 to be there. We're going to work your behind off for 8 hours. You will have access to the tape for a year, and you'll need it because we're going to give you more information in 8 hours than you can possibly consume in 8 hours. Full gold-plated money-back guarantee. If you attend and you don't think we gave you your money's worth, simply email us. We'll give you your money back. But our granddaddy product is the Natural Resources Investing Symposium. July 7 through 11 in Boca Raton, Florida. I believe this may be our 30th year, which means we've stood the test of time. Great big picture thinkers, great macro, the Jim Rickards of the world, the Daniela DiMartino Booths of the world, the Nomi Prinzes of the world, the Grant Williams, the Bill Bonners, the Doug Caseys. People who tell you about the way the world is, not the way the big thinkers would want you to believe it is. From there, we teach you how to make money from it. Great natural resource analysts, not failed hacks who couldn't do technology, couldn't do consumer finance, and were parachuted into natural resources so they couldn't do any harm, but rather people who have made money in natural resource markets for 30 or 40 years. Better than that, we always have the living legends, people who have built multi-billion-dollar natural resource companies from scratch, telling you about their successes, telling you about their failures, telling you about how the processes made them better investors and how you can be a better investor too. Importantly, again, absolute ironclad, gold-plated money-back guarantee. Whether you come to Boca Raton in person, July 7 through 11, which would be my preference, or if you join 1,000 people online for the live stream, first of all, you'll have access to the tapes. You'll have access to the recordings, which you'll need. Over 4 days, we're going to give you something like 50 hours of intense programming. This is not like watching TV. This is like working. So you'll have the ability to review the material that we've given you for a very long time. And again, whether you attend in person or online, there is a gold-plated money-back guarantee. If you think for any reason that the content that we gave you isn't worth the price that we paid you, you pay nothing. There's no other information provider I know of in the world that is confident enough in their content that they give you an ironclad money-back guarantee. I'm delighted to tell you, Jeremy, in 30 years of full money-back guarantees, I've had to refund about 0.1% of the tuitions that I've charged. But that notwithstanding, as an inducement to get people to come, gold-plated money-back guarantee.
Phenomenal. Thank you very much for that, Rick. And yeah, if you're in our audience and you're interested, do head over to ruleinvestmentmedia.com. Check out the Rule Symposium as well. Rick, it has been an honor and a pleasure to speak with you today. I thank you very much for your time, and I hope we get to do this again very soon.
My pleasure, gentlemen. I've enjoyed the process, particularly the process around investor education, which is the greatest joy a guy my age can have. So to the extent that your audience thinks this has been worthwhile and asks you to have me back, I would love to be back.
Excellent. Yeah, and we take that education side very seriously as well over here. So we'll definitely arrange that, and we'll have you back on perhaps after the symposium. Wonderful. That is all for us today. Thank you so much once again for watching, to Rick Rule for joining us. Check out the Strategic Wealth Preservation YouTube channel for all of the information you need to know on precious metals investing, or email us at info@swpkman.com, and a member of our team will assist you. Again, head over to ruleinvestmentmedia.com and check out the Rule Symposium, the boot camps, and all of the other great materials that are there. And until next week, stay safe and happy investing.
Thank you for listening to Inside the Vault, the podcast that opens the door to precious metals. We hope you learned something new and enjoyed the show. See you next time on Inside the Vault with SWP.